let's dive straight into what's happening in the Middle East and how it's shaking up the global stage. The Israel-Gaza conflict has ramped up dramatically again, and the scale of the impact it's staggering. This time, hear this, the largest hospital in southern Gaza has been struck.
Yeah, and those reports are heartbreaking. The civilian toll is enormous. When we talk about strikes on critical infrastructure like hospitals, the ripple effects are massive. These are lifelines, not just for the injured, but for entire communities. It creates long-term instability that's hard to quantify.
Exactly. And from an investor's perspective, it's not just a human crisis, it's a market one. Regional stability is the backbone of market confidence, especially in the Middle East. Oil prices? They're already up, 15% this month from last year? That's wild.
Yeah, and there's this sense that unpredictable conflicts like this kind of keep investors on edge. I mean, how do you plan for markets influenced by something as volatile as, well, geopolitics? It's more than just supply chains being disrupted. It's investor psychology. Fear trickles down, even to sectors seemingly removed from the front lines.
True, and energy markets are always the first to feel the brunt. We've seen oil prices fluctuate in response to even whispers of unrest. For investors, this can mean wild swings in portfolio valuations. But there's a silver lining here: resilience strategies.
Right. And this is where the idea of diversification really shines. By spreading investments across less crisis-prone sectors and maybe even venturing into renewables, something we've seen gain momentum, a portfolio can absorb these shocks better.
And don't sleep on sectors that thrive in crises. Think defense companies or even, oddly enough, logistics. It's fascinating how crises sort of reshape the way certain businesses are perceived, not just as risks, but as opportunities.
Yeah, it's a concept I refer to often. Seeing beyond the immediate chaos to identify what's structurally sound. And while energy might feel risky, there are opportunities within the broader spectrum of regional investments. So, in a way, it's not about avoiding risk altogether. It's about understanding it.
Totally. And honestly, if everyone pulled out of a region every time there was conflict, economies would collapse faster, sometimes just staying in place to the long-term game. But I think a lot of this depends on how human events, like suffering and politics, steer the financial conversation specifically in the short term.
Right. And that takes us back to the idea of long-term resilience. What sectors can thrive no matter the crisis? Energy, for its global necessity, will always bounce back, though it's turbulent. But how companies transform, say, disruption into innovation, remains key. I think that's something we'll see more of, adaptation under pressure. Shifting from one geopolitical hotspot to another, let's talk about the Russia-Ukraine conflict and the ongoing efforts to negotiate a ceasefire in the Black Sea. The stakes there are enormous. Securing a maritime truce could unblock critical shipping lanes, restoring much-needed normalcy to global wheat supply chains. A lifeline for the world's grain trade amidst mounting instability.
Absolutely. And, Jenna, it's wild to think that a single agreement, just one, could stabilize so much. Like, we're talking about wheat prices that have been riding a roller coaster ever since the invasion disrupted supply. Just last year, prices hit a crazy 40% spike at one point. That's no joke for economies reliant on imports.
Right, and wheat is just one piece of this. The broader implications, especially for energy markets in Europe, can't be ignored. Europe's energy security is already so precarious. Any shift here could exacerbate those vulnerabilities, whether it's dwindling natural gas supplies or nations scrambling to diversify their energy mix.
Exactly. And you've got to wonder, how long can they pivot without building massive infrastructure for something like renewables or LNG? But here's what's intriguing. The rest of the market doesn't stay still during all this. Think about the geopolitical chess moves happening. Shifting alliances, new trade partners stepping up. It's fascinating from an investment standpoint.
Yeah, it's the ripple effect, right? When markets are hit by a shock, you're not just looking at immediate losses, you're looking at new patterns emerging. I mean, even looking historically, have you seen moments where investors navigated through similar unrest? How did they anchor themselves amidst all the uncertainty?
Oh, absolutely. Take the Persian Gulf tensions, or even big market disruptions like the Euro crisis of the late 2000s. Same kind of situation. Investors who thrived didn't panic. They went defensive, rebalanced portfolios, hedged strategically. Diversification was their friend, but timing was everything.
And hedging, it's such a vital tool, isn't it? Being able to mitigate against worst case outcomes without withdrawing entirely. I think part of the challenge is knowing when to adapt and when to simply hold on and weather the storm. That restraint takes, well, wisdom, I suppose.
Totally. Like, take energy stocks right now. Sure, they're risky, but the upside can be insane, especially when markets kind of, overreact. That's where the opportunities pop up. You can capitalize on volatility if you're brave or if you just know how to read the room, so to speak.
That speaks directly to the broader idea of resilience, doesn't it? Seeing uncertainty not just as something to survive through, but as something to harness. Whether it's in grain shipments out of the Black Sea or renewable energy investments, what thrives under pressure might define what comes out stronger in the end.
Exactly. And let's be real. This whole situation, both politically and economically, kind of forces investors to rethink everything. It's not just about sitting out the storm, it's about finding where the rain lays down the seeds for what's next. Jenna, speaking of navigating uncertainty, Turkey's making waves again, this time with the arrest of Istanbul's mayor. That's a political earthquake, no doubt, and the ripple effects? They're shaking investor confidence hard. How do you think resilience plays into this situation?
Absolutely. Political instability can send shockwaves through an economy, especially one like Turkey's, which has had its fair share of challenges. The arrest doesn't just raise questions about democracy, it deeply rattles investors. When governance feels unpredictable, confidence wanes, and that's critical for financial markets.
Right, and one of the first things we're seeing here is the Turkish lira taking yet another tumble. It's been under pressure for, years? But these kinds of events just light the fuse on an already volatile currency.
Exactly. It's almost like a cycle. Political turmoil leads to economic uncertainty, which fuels depreciation. And the lira's instability becomes a reflection of lacking investor trust. I think the key question is how long this can go on before structural damages become irreparable.
Yeah, and the bond market isn't ignoring this either. Turkish bond yields are climbing, signaling higher risk premiums. It makes you wonder, will international capital keep flowing in, or has the point of no return been crossed?
And that's the concern, right? The higher those yields go, the more expensive it becomes for Turkey to fund itself. And this isn't happening in a vacuum. Global markets notice these things. It's a domino effect. Investors are not just gauging today's risk, they're projecting future vulnerabilities.
And let's not forget how international perception weighs into this. Markets are hyper-reactive to political drama. Like we've seen before, even the hint of authoritarian governance, it's an instant red flag for foreign capital. No one wants to be caught up in a liquidity scramble.
Right, and I think this speaks to the importance of integrating political analysis into financial planning. Political events can seem chaotic, but understanding their undercurrents allows investors to position themselves more strategically. It's about being proactive, not reactive.
Exactly, because there are always opportunities, even in the chaos. Look at emerging markets broadly. Some thrive by defying the odds during instability. It's all about reading the terrain. And honestly, this is why we do what we do, helping people navigate these complexities.
Absolutely, and for me, it's always about taking a step back from the noise and focusing on resilience. Where do we see structural strengths that won't buckle under pressure? Political storms tend to pass, but the right strategies can anchor portfolios through it all.
Totally agree, and that's going to be key as we watch how this plays out in Turkey. Thanks for breaking it down with me, Jenna.
Always a pleasure, Ethan. And for everyone listening, remember, uncertainty isn't the enemy. It can be an opportunity if approached thoughtfully. Until next time, stay curious and stay informed.